Hi, I'm Jeff Stouffer, founder of Stouffer Wealth Advisors, and this is the first course in our 3-course video series, Financial Lessons from the Kitchen. Imagine enjoying a sumptuous 4-course meal in a fabulous restaurant. The meal provides a wonderful adventure for the senses through a variety of enticing smells, flavors, textures, and colors. The progression of the dishes is carefully orchestrated from the light, appetite-stimulating first course to a savory entree, finishing with something sweet and satisfying. Many of the same concepts used to create such a meal also apply to investing for the future. Let's look at some of the ways in which an extraordinary meal is similar to investing. If I hand you a menu, you know what to do. You make choices based on what you like, what your body needs, and what you might really crave at the moment. Your choices are based upon your particular needs and preferences, and of course your values and priorities. This is also true of investment choices. An investment menu should consist of 4 courses: cash, fixed income, stocks for the main course, and real estate alternatives for dessert. The concept of the investment menu and its correlation with meal planning is a way of describing asset allocation. Asset allocation is the investment term used to describe the percentages you own in each of the main categories of investment. So let's take a closer look at this idea of an investment menu. When preparing a special meal for guests, you intuitively include a good variety of ingredients. That is to say, you diversify. The menu itself is a brief description summarizing a complex entity. The investment menu likewise provides a description of your investment strategy and diversification. For example, an investment menu might consist of 5% cash, 40% bonds, 40% stocks, and 15% real estate and other. In a multi-course meal, each course serves a unique purpose, and it's the same with the major classes of investments. The first course is cash, which includes savings accounts, money market funds, and CDs. And these provide liquidity, which means you have easy access to your funds and can easily convert them to cash. And the investments do not fluctuate in value. These investments are extremely safe, but they do have a key fundamental risk. They don't generate much in the way of return, and therefore do not keep pace with inflation over time. That is to say, they don't appreciate in value. On a brief side note, the reason we have savings and investments is to own assets that appreciate over time. Our money works for us over the years by growing, hopefully faster than inflation. The second course is fixed income or bonds, which I like to equate with hot soup on a cold winter day. Bonds provide a steady income stream with relative price stability. So a bond is like a loan you make to a company. It pays a regular interest payment twice a year, and you get your principal back at the end of the loan. The returns are generally higher than those from cash, but with a bit more risk. Equities, or stocks, are the main course, and if you need growth in the portfolio, as most of us do, this course will be the most substantial. As mentioned earlier about owning assets that appreciate faster than inflation, most of the growth comes from here. Stocks are also the most risky. You want to be well diversified within this category, and that might include using stocks of U.S. companies across the size spectrum from small to large. It would also include using stocks from international companies in both developed countries and emerging markets. And although your need for growth may be great, be careful not to overeat. Stock markets periodically remind us that the price of potential reward is risk. The composition of your main course will depend both on your personal needs and capacity to assume risk. The dessert course, real estate and alternatives, is a bit of a catch-all, but real estate is a major category and should be included in most portfolios. Alternative investments have also become more important in the last decade or so. Examples of these are gold, oil and gas partnerships, absolute return, and hedge funds. And the dessert course allows for additional diversification beyond the traditional cash, bonds, and stocks. So why should we care about the investment menu? Well, what most people don't know is that it really is the most important decision an investor has to make. The percentage of assets that are invested in each course or category reflect how much risk you want to take, as well as how much your investments may grow over time. And here's an important statistic that's often overlooked. 85 to 90% of the return of a portfolio comes from the nature of the investment menu, from asset allocation. So in other words, the selection of the percentages in each major category is more important from the returns than the investments you select. Individual investments typically generate only 10 to 15% of the return. Finding the next Google, Netflix, or Tesla is not the path to a brighter financial future, though it couldn't hurt. It pays to focus on the bigger picture. We know that a meal having a variety of flavors is desirable. The same is true with investments. The investments in each of the 4 categories need to reflect a similar diversity, meaning that you diversify within each course. If you simply had a piece of grilled fish on a plate, it wouldn't necessarily be that satisfying. Adding a relish of cucumber, tarragon, lemon juice, and olive oil transforms the fish into something much more interesting and delicious. So diversifying within each course on the investment menu is as important as combining multiple flavors on your plate. In thinking about your investments, focus on what matters most: the investment menu, the percentages you own in each of the 4 courses: cash, bonds, stocks, and real estate. These provide the foundation of an investment portfolio. The key point is that it offers the greatest opportunity to manage risk while determining how much your portfolio is likely to grow over time. The investment menu is a picture, often represented as a pie chart, yet another food reference, showing vital information about your investments. Just as with food, the choices comprising your investment menu reflect what is required for good financial health, as well as your values and priorities and goals. If you want to build your nest egg and can take the risk, your menu will have a greater amount invested in stocks. If you're retired or more risk averse, bonds will make up a greater portion of your investment menu. So think about your investments as a wonderful meal you're planning. Carefully select the finest ingredients as if your best friends were coming to dinner. Creating an investment menu may not be quite as stimulating as a stroll through the farmer's market, but it can be every bit as nourishing and fruitful. I hope you enjoyed this fresh look at planning for your future. We looked at planning from the standpoint of the dinner party for friends and how it can be a reflection of our values. Clarifying and prioritizing values is a key part of the planning process. We looked at some of the psychological reasons why saving for the future can be a challenge, and that our money doesn't always go to what matters most. Financial planning is great for addressing these issues and the work that needs to be done before investing. It's no longer enough to be a good saver. You need to be a good investor as well. And this menu framework, as a metaphor for asset allocation, will serve you well in appreciating the importance of your investment allocation and how to think about growth, risk, and returns. Time is your best ally in growing a nest egg. If you haven't started in earnest, now is a great opportunity. If what you heard here makes sense to you, by all means, call me for a complimentary session to discuss your most pressing needs for the future. Let's work together on your recipe for a bountiful retirement. I'm Jeff Stouffer. It's been my pleasure to share this information with you. I look forward to meeting you.